A short time ago, precious metals were tearing through historic ceilings. Investor euphoria was at a peak. Price targets were being revised higher by the hour, and the upward momentum seemed unbreakable. Then, that confidence shattered. Gold took a sharp vertical plunge. In a single overnight session, the market erased months of gains, leaving long-term holders watching a total reversal of fortune in real time. Silver suffered an even more aggressive collapse, enduring its most violent weekly drop in years. Billions of dollars in market value evaporated, seemingly into thin air. In the aftermath, two questions remain. What triggered a sell-off of this velocity, and who actually walked away with the capital? A coordinated collapse of this magnitude signals a systemic anomaly. It reveals a moment of forced liquidation, where the immediate need for cash overrides every other market signal. The mainstream narrative provides a tidy explanation, attributing the drop to a Federal Reserve nomination and a slight uptick in the US dollar index. Traditional analysts point to ordinary profit-taking, suggesting that investors simply reached a collective decision to cash out their winning positions simultaneously. However, the data contradicts this simple view. Standard profit-taking creates a gradual descent. It does not produce a violent, synchronized freefall across the entire precious metal sector. This mainstream alibi ignores the actual catalyst, a desperate, systemic scramble for liquidity that signals a much deeper fracture in the financial world. To find the true cause, we have to look away from commodities and toward the institutional investors who were caught on the wrong side of highly leveraged bets in unrelated markets. This brings us to the mechanics of a margin call. When a leveraged fund loses money in risky assets, their brokers demand an immediate infusion of cash to cover the losses. If that cash isn't sitting in an account, it must be generated instantly. These institutions often cannot sell their losing bets because those markets have become illiquid. To survive the day, they are forced to drain their winning positions, assets like gold and silver that can be sold for cash in seconds. In this environment, gold and silver are no longer being traded for their value as a hedge. They are being used as a high-speed ATM to plug holes in failing portfolios. This creates a rapid domino effect. The forced selling drives the price lower, which triggers a new round of margin calls for other traders, resulting in an uncontrolled downward spiral. Gold and silver functioned as the emergency exit for an over-leveraged system. Their value in this moment was defined entirely by their liquidity, the ability to be converted into cash instantly to stop a systemic bleed. Identifying the sell-off as a margin call is only the first step. We have to identify where the massive institutional losses that triggered those calls actually originated. The timing of the crash aligns with mounting unspoken stress within the traditional banking system. These are losses that have not yet reached the public earnings reports. The primary suspect is the private credit market, a multi-trillion-dollar sector where massive amounts of unmonitored leverage are stored away from the eyes of regulators. Because private credit is notoriously illiquid, a fund manager cannot simply sell a private loan to raise cash during a crisis. Instead, they must dump their most liquid public assets. The crash in gold and silver is the visible evidence of an invisible crisis in the credit markets. A systemic scramble for cash on this scale reveals a financial architecture operating with dangerously low reserves and extreme fragility. The gold and silver crash functioned as a pressure valve, releasing the initial energy of a deeply stressed financial system. This event exposes the fragility of a global financial architecture built on layers of unstable leverage. Precious metals were merely the messenger. The evidence suggests a crisis is currently incubating in the shadow credit markets, waiting for a final catalyst to break through to the mainstream economy. The next time a safe haven asset drops inexplicably, do not analyze the asset itself. Identify who is suddenly desperate for cash. This overnight collapse will likely be remembered as the first tremor, the warning sign before a much larger earthquake shifts the entire financial landscape.